this meeting of the Local Government Pension Scheme. Firstly, I'd like to welcome Laura and Eric from our funds actuaries, and also Nick and Andre, Nick online and Andre with us in person, from Hymans Robertson's, our investment advisors, and also Julian Gillett from Audit Wales. Thank you. The first item on the agenda is apologies for absence.
Apologies from Councillor Jan Curtis.
Thank you. Moving on to the second, which is disclosures of personal and prejudiced interest. Can anyone indicate if they have those? And can you make sure you fill in the form afterwards? Yes, each individually. Yes, yes, you need to declare individually. So I'll go first. Yes, I'm a beneficiary of the pension fund. So I don't know about you.
Yeah, my brother's in the pension fund, Chair.
Will?
Yeah, member of the pension fund.
Steph, did I see your hand up?
Yes, member of the LGPS.
Mike, are you? Mike Locke?
No.
Did you have your hand up, Mike?
Patience.
No, sorry.
Oh. Patience, I see you.
Member of the LGPS, Chair.
Thank you very much. And no, any officers? Sorry, I jumped into you first there, Steph, but any other officers?
Member of the LGPS, Chair.
A member of the LGPS, Chair.
And member of the LGPS, Chair.
I think that's everyone. Thank you. So can we move on to minutes of the previous meeting? So you'll find those on pages 1 to 3. And page 1, page 2, and page 3. Are we all happy that that's a true record of what transpired?
Yep.
Okay, let me sign those. Moving on to item 4, and that will be a report from Audit Wales from Julian Gillett.
Thank you, Chair. Good morning, everybody. This is our Audit of Accounts report, which summarises the main findings from your 2021-22 financial statements audit. Auditors can never give complete assurance that accounts are correctly stated, and instead we work to a level of materiality, which is set to try and identify and correct misstatements that might otherwise cause the user of the accounts to be misled. This year we set the level at 29.3 million. We've completed our audit work, but under auditing standards, there are some matters that we need to report to you before you approve the financial statements. I'd just like to say we've continued to work remotely and with the finance team throughout the accounts process, and we'd just like to express our thanks to the team for the help and support they provided to us in giving us the audit evidence that we've needed to complete the audit. Onto the good news then, that the AGW intends to issue an unqualified opinion on the financial statements once you've provided us with the letter of representation, and the proposed audit report is set out in Appendix 2 on page 13 of the report. There are no significant issues arising from the audit that we need to bring to your attention. There are no uncorrected misstatements. There were some misstatements in the accounts, but these were mainly presentational in nature, had no impact on the net position, and they've been corrected by management. We did identify one other issue which resulted in us making a recommendation. This is set out in Exhibit 2 on page 9, and further details of the recommendation are in Appendix 4 on page 19, and corrective action has been agreed with management. And then on Appendix 1 on page 10 just sets out the letter of representation we require from you before the AGW can issue his opinion. And I'm happy to take any questions if anyone's got any. Thank you.
Have we got any questions for Julian online or in person? Yes, Jeff, can I pass it over to you?
Thanks, Chairman. I'd also like to pass on my thanks to Gillian and her team for conducting the audit. You know, it's been continually challenging to undertake audit work remotely. However, yeah, want to commend Gillian and her erstwhile colleague Dan King, who's now left Audit Wales, for their work on the audit of the scheme, and I'm very satisfied with the outcome. Also, I'd like to put on record my thanks to my colleague Karen Carr, because ostensibly the output of the annual report is largely down to her efforts and her team in the pension fund and treasury management team. It's a testament to that good work that the audit opinion is unqualified, and the very low number of corrected misstatements. Normally, in an audit report of this nature, you would see a schedule of corrected misstatements, and as such, they are of such a trivial nature that there isn't even a schedule of corrected misstatements in this case. And also heartened to find that the one item worthy of bringing to management control is a good practice recommendation put forward by Audit Wales about the controls and audit assurance reports, which management have agreed to and take that recommendation forward. So very pleasing again, Chairman, and thanks again to all those involved.
Thank you, Jeff. And on behalf of the committee, I'd also like to echo those comments made by Jeff. Thank you very much, Chair.
Thank you, Chair. Thank you, Jeff.
Moving on to item 5 on the agenda, which is a report of the statutory appointed actuary. So, over to you.
Thank you, Chair. And hello, everybody. It's a pleasure to be here today. I'm Laura Caldwell, so I'm the appointed fund actuary, and I work for Aon. And I'm joined by Eric Gabas, who's also working on the actuarial appointment for the fund. So, as I said, it's a pleasure to be here today to present the initial results for the fund. Under the regulations, we, as the actuary, will determine what the contribution rates for all of the employers who participate in the fund will be. But in order to do that, we do need to have regard to the funding strategy, which is decided by the committee. So we're here today to talk to you about what we propose the strategy approach will be for this valuation, and that in turn leads to what the assumptions will be, and therefore what the outcome of the valuation will be in terms of contributions for employers. Just moving on, we're on to page number 23 of the pack that you've got, just onto the agenda of what we're going to talk about today. So first of all, Eric's going to talk you through the valuation process and the assumptions that we've used. And that will be quite brief because we have covered this in quite a lot of detail in some pension committee training that we carried out on the 20th of October. Eric will then also talk you through the initial results for the fund. Then I'll pick up from Eric to take part 3 and 4, which is expectations for employer results, and then sort of the next steps and how we finish off the valuation. So I'll hand over to Eric now to take us through the assumptions.
Thank you, Laura. Thank you, Claire. So I'll start on, so if we move on to slide 25, and I will start from a quick refresher in terms of what the actuarial valuation is, how we go about valuing the liabilities, and talk a bit about the assumptions and the funding strategy statement. So starting on from the actuarial valuation, this is an assessment of the financial health of the fund. And what we do as part of the valuation, we compare the assets to the value of the liabilities. The value of assets is taken from the fund accounts and is taken at market value. In terms of the liabilities, this is calculated by us, the fund actuary, by taking into account the membership of the Swansea Pension Fund and using assumptions set by us. If the funds got more asset than the liabilities, then we are in surplus. If the opposite is true, then the fund is in shortfall or deficit. We also talk quite often by a funding ratio, and this is simply a ratio of assets to the liabilities. And if that is greater than 1 or greater than 100%, then the fund's got more assets than the liabilities. And the main, from the point of view of the fund, the main objective of the valuation is for us to prepare the actuarial report and to set contribution for all the employers. And in terms of contribution, we require to set it in 2 parts. We set the primary contribution rate, which is the contribution needed to finance the benefits accrued from the valuation date. And the secondary contribution, which is the contribution required to either clear the deficit which exists at the valuation date, or redistribute any surplus if that is required. Moving on to the next slide, which is 26. So how do we calculate the liabilities? Well, as I mentioned, we take the membership of the fund, and then we create a profile of the cash flow. So basically we look at every single member and we look when the payment will be coming into payment. And we use actuarial assumptions for it. The financial assumptions more or less determine the level of those payments, like the pension increases, the pay increase, and then the demographic assumptions determine when that payments will be coming into force and for how long they will be paid. So if we move to the next slide, this is number 27 in your pack. This is a very brief summary of the membership of the fund and a look on what's happened since last valuation in terms of experience. So on the left, we've got summarized the membership numbers. As we can see, they're going up each year, each valuation. And then at the bottom left side, we've got summary of the average ages. And when we have a quick look at them, we see that they're increasing steadily, which indicates that the fund is maturing. If we look on the right of that slide, we've summarized the key assumptions which determine the size of those future payments, which is the CPI inflation, and then link to it the pay assumption. And based on our work and what we analyzed over the 3 years, so at the 2019 valuation, our assumptions for the CPI was 2.1%. And this was broadly in line with the observed CPI or the pension award increases over the 3 years. It was slightly above, which created a profit for the scheme. And the same is true for the pay. From our analysis, we can see that the pay awarded over the 3 years was slightly below our expectation. Right, moving on to next slide. I will just go through quickly the elements within the funding strategy of the fund. As Laura mentioned, we, the actuaries, when setting the assumptions, need to have regard to the funding strategy of the fund. And the key elements of that funding strategy are the prudence, the level of prudence, and that prudence is allowed in our assumptions, and it's to ensure the long-term solvency of the pension fund. We look at the employer risk. Every employer's got slightly different risk, and this is reflected in our assumptions. We also, that there is a provision for pooling some of the risk and costs. So across the fund, the death in service lump sum payment is pooled, and employers pay a constant cost and then don't see variation in their position due to the death in service. And also we've got a small cancel groups within the fund, and those employers are pulled together for setting the future service cost, because otherwise their position would be very volatile. So it's all to do with smoothing the contribution for the employers. And also at the bottom of that slide, this is the page 28. So we talk about the deficit recovery period and smoothing. So these are two mechanisms which help us to ensure that from valuation to valuation, we try to ensure that the employer contribution as stable as possible. Moving on to next slide, this is just the summary of all the assumptions we need to, of the key assumptions we need to make as part of the valuation. In blue, these are the financial assumptions, and the key one is the discount rate. Historically, CPI was relatively flat, but we now seeing that it starts to bump up, and this is a more, we now pay a bit more attention to the CPI assumptions as well. And then in the gray, we've got all the demographic assumptions we need to make to calculate the liability for the pension fund. And I will now talk a bit about how do we set the post-retirement mortality, as this is the key assumption, and it determines for how long the pensions will be paid. So moving on to next slide, this is the page 13. So how do we set the mortality? So we look at the Swansea data, and then we use our in-house model, Demographic Horizon, which holds the information about mortality per postcode. We overlay the two, and then we come up with a best estimate assumptions for the base mortality. In terms of future projections of that mortality, we use industry standard, we use the CMI tables produced by the actuarial profession. And at the bottom of the, so we've done all the analysis for this valuation, and our proposed 2022 valuation assumption is slightly weaker than the 2019 valuation, leading to a small reduction in liabilities, but less than 1%. And this can be illustrated by the life expectancy summarized on the bottom left corner of the page 13. And it's probably, I should mention that when we undertake this analysis, we do allow for the recent experiences for the effect of the pandemic. And moving on to next slide, this is just a quick summary of what's happened in recent years. This is results published by the actuarial professions, and the graph shows the standardized mortality rate through time. So if we look at the gray bars, they represent the kind of average mortality between 2011 and 2019. And then we've got a 2019 line, which I believe is in,
It's blue.
I think it's blue. Sorry, I've got only black and white copy of my slides. Apologies for it. And then we see the other years, and then we can see the prominent peak in kind of April, March when the pandemic hit. But what's key from this slide and what we can observe is that there have been more deaths than expected. However, also for a prolonged time or for periods of time, the excess deaths been below that expected. And then when we look at a sample and LGPS fund to see what effect of that might be on the results, they were very small. And this could be down to the differences between the LGPS and the national populations, or could be that the members affected, this is very actuarial view, and I know it's really harsh, but the members affected might have smaller pension, and therefore there was a lower impact on the liability of the LGPS. And then moving to the next slide, we kind of look at that pattern observed from the pandemic and overlaid it with the experience from the Swansea Pension Fund, and decided that the best view we can form at the moment would be to adjust the scaling factors for the mortality table to increase them slightly. And by increasing the scaling factors on the mortality tables, we assuming that members will be dying slightly quicker. So we've kind of taken it into account, but it is good to bear in mind that it is very early days and we know very little about how the mortality will look in the future. We know that members were dying quicker. However, it could be that the deaths were just brought forward, and we will observe now less deaths going forward. We know there is impact of long COVID, and we don't really know yet what effect would that have on the future. So something to look at the next valuation to have a look whether we've got more data to form a kind of more concrete view. Moving on to next slide, this is page 33. This is just to highlight that when setting the other demographic assumptions for the pension fund, we've taken into account the experience of Swansea Pension Fund when appropriate and when we've got enough data to form those views. Moving to next slides, I will now start to talk a bit more about the financial assumptions. And as everyone knows, the Swansea Pension Fund is a multi-employer fund, and there are different employers. They've got different circumstances in the fund. We've got some employers which no longer have any active employers, and all the liabilities, we call them orphan. There is no active employer backing those liabilities. And then when we value the liabilities for those types of members, we use low risk, kind of a guild basis. And then we've got employers who has a close participation in the scheme, so we expect them to leave at some point. And by virtue of this, we expect them to, once they leave, the liabilities will become on orphan. And then at that point, we would like to ensure that at the point of leaving, the liabilities will be fully funded on this low risk basis. And then we've got on the other spectrum, we've got the secure schedule body employers who will be in the fund for a long time. They still open, they admit new members, so they're not going anywhere. So for those employers, we can use slightly weaker assumptions because they've got more time to recover any fluctuation in the asset values. So moving on to next slide, this is page 35. How do we set the discount rate? So I haven't mentioned yet, but most of our assumptions, apart from the discount rate, are best estimate. So they are set to be 50% chances of being correct. And the way we allow for the prudence is through discount rate. So to set the discount rate, we first look at the expected return that could be achieved on the pension fund assets. And then, so that would be the 50% chance. But because we need to ensure that the fund in the long term is solvent, we don't just want to have a 50% chance to be correct. We want to have be a bit more prudent to ensure that we definitely will have enough assets to pay all of those benefits promised to members. And the measure we use is the probability of funding success. And at this valuation, we propose to use the probability of funding success of 83.5%. This is an increase from the probability of funding success used at last valuation. At last valuation, we used 80%, so this is a small increase to reflect where we are at the moment and what the market and future returns might look like. And then if using that probability of funding success of 33.5%, the discount rate would be 4.1%. And then if we move to the next slide, we've got a summary of all the financial assumptions. So in the left column, we've got the 2019 assumptions and the discount rate at the 2019 valuation assumptions for the schedule body and for the schedule bodies were 4.25%. We are now proposing to use 4.1%, but if we were to use simply the same funding strategy as at the 2019 valuation, the discount rate would increase to 4.35%. And this is not in your slide, this is just for information to kind of show that we're making steps to make the assumptions a bit more prudent. And also probably worth pointing out the bottom at the table, there is the short-term inflation loading. And at the 2019 valuation, we haven't made any allowance for a short-term inflation because we weren't expecting the inflation to suddenly increase. But at the 2022 valuation, we're now seeing the inflation are above our expectations. So at the time where we were setting the inflation assumption, which was back in June, and our long-term assumptions at that point was 2.3%. We were expecting the inflation to be slightly above that level, but nothing we're seeing at the moment. And we pretty much certain that the next pension increase awarded in April 2023 will be 10.1%. And to counteract that, because once that's awarded, then more or less the liabilities will be increased by that 10%. And to counteract that increase and not find ourselves with a deficit at the next valuation, we propose to include the short-term inflation loading to allow for this September high inflation. And we expect as well that the next September, the inflation will not go back to the kind of 2% level. It will probably be somewhere in between. I think the expectation of the Bank of England is around 4 or 5%. And that 10% loading basically allows for both of those higher increases. So that was very quick whistle stop tour of what we do to calculate how we calculate the liabilities and how we set the assumptions. And now I will move on to the
Chairman, if I could just ask a question.
Absolutely.
Yes, Jeff. Sorry.
Thanks, Chairman. Thanks, Eric. Just for the benefit and just to reinforce what Eric is summarising there in terms of the key financial assumptions being recommended, is that on all bases we're recommending an increase in prudence in the assumptions adopted across all those metrics. You can see, we're increasing the levels of prudence. We're recognising where we are in the financial cycle, the likelihood of achieving those outsized investment returns going forward in the next 3 years and beyond, and also recognising the matching switch in the ongoing switch in the investment strategy, where we are commensurately taking risk out of the investment portfolio at the same time. So the assumptions adopted sort of mirror the actions of the investment strategy as well, but also for actuarial purposes and for government actuaries department purposes, it can demonstrate appropriate levels of prudence and improving prudence levels from the 2019 position, which is good. And don't want to steal Eric's thunder, but the next slide will indicate the actual outcome of adopting those new assumptions at the 2022 valuation outcomes. Thanks, Chairman. Sorry, Eric.
Thank you, Jeff. Carry on.
Thank you, Jeff. Thank you, Jeff. Yeah, that is absolutely true. And now if we move to slide 38, I will just quickly remind what was the position at the 2019 valuation. So at the 2019 valuation, the funding level of the fund was 91.5%, and there was a deficit of around 191 million. Moving to the next slide, this summarizes the 2019 valuation position and the initial 2022 valuation position. So the funding level increased from the 91.5% to just over 100%, and the surplus, and now the fund is in surplus, is a small surplus, but is a surplus of around 3 million. However, as Jeff mentioned, we increased the prudence. So if we were to look at the results based on the 2019 funding strategy, then the funding level would be around 110%. However, we kind of reducing that and refraining a bit just what Jeff said, because there is changes in the investment strategy. We've seen what's happened to the financial market. We've seen the drop in asset. We've seen the high inflation, and I think this morning was published the inflation for October, which was 11.1%, which again is quite high. So we're seeing those high inflations. So it is to ensure that once we come to the next valuation, we suddenly don't have a deficit, and it's all about smoothing the contributions for the employers. So moving to the next slide, this is just briefly to explain why we're in such a good position now, and it is very good position because we can increase the prudence, And at the same time, the funding level is 100%, which is really good result. And this is mainly due to the phenomenal investment returns the pension fund achieved over the 3 years to the valuation. So when you look at the chart on page 40, on the right side, the dark gray bars, this is all the items which improve the position. And on the left side, we've got the items which worsen the position. And as you can see, the investment was the main, and then it was offset by the changes in the financial assumptions. And the main reason for that financial assumptions bar being relatively large is that 10% inflation loading. Moving on to next slide, this summarizes what would be the primary contribution rate and the total rate for the fund on the 2019 valuation and the proposed 2022 valuation. So when you look at the first row, this is the value of benefit accruing. So at the 2019 valuation, this was 26%. Now with changes in the assumptions, it is 27.1. So a small increase. The expenses, our expectation of expenses stayed the same, and the member contribution rates on average also remained the same. And this resulted that the primary rate moved from 20.2% to 21.3%. However, it is, and Laura probably touch a bit more on this later on, at the 2019 valuation, we've allowed for impact of the McLeod judgment and cost management, and we kind of loaded a 1.5% into the employer rates. As this is all now in the past and it's included in the past service liabilities, there is no longer need for that loading, so that 1.5% will disappear from the employer contributions. And when we now move to the bottom of that table, when we talk about the secondary contribution or the deficit surplus contribution at the 2019 valuation, because there was a deficit, on average, employers were required to pay 3.3% into the fund. However, as the fund is in surplus at the moment, there is no past service contribution. And because we are 100% funded, we are not on average handing out surplus to any of the employers. So the total rate for on average across the fund, and the story for each employer will be slightly different, and Laura will talk a bit more about this, is that the employer total rate reduced from 25% to 21.3%. But this is still with increasing the prudence. Yeah, sorry, Jeff. Yeah.
Thanks, Eric. Thanks, Chairman. In an actuary's usually understated way, Eric just passed over the one slide, that we'd like to, dwell on, perhaps, the reporting on the fact that at the outcome of this valuation, the fund will be 100% funded.
Yes.
You're usually understated actuarial way. You've just flirted over that. I mean, for us, it's an historic moment. It's the first time for the fund ever to have been in that position. Definitely in my working lifetime, over 20 years at the fund, and as Eric says, it's in no small part to the very, very positive and outstanding investment performance that we've experienced during the last 3 years. And again, I just want to reinforce that we're recognizing that, taking some of that risk off the table, banking some of those gains, and having that being recognized in the ongoing prudence looking forward that Eric is sharing with you now. But just wanted to place on record, Chairman, that actuarially, for the first time at valuation time anyway, obviously we've touched over 100% funding intra valuation cycle previously, but actually on valuation date 31st March, when the guys come to certify their rate certificate, it's the first time that we're going to be in surplus. So thanks, Eric. So sorry for interrupting.
No, that's absolutely
Carry on.
Absolutely correct. Yes, yeah. This is really good news. And then I think I will skip the next slides. It's just kind of explaining why the future service increased, but I've kind of touched on it. It's the main reason was that the change in the financial assumptions, and this was offset by changes in the demographic assumptions. And then obviously, because we are actuaries, as Jeff alluded to, there is the page 43, where we talk about the risks and then just want to show some sensitivities to key financial assumptions and the performance. So this is just to illustrate that the results are very sensitive to some of the assumptions. I will now pass on to Laura to talk to you about the expectations for employer results. Thank you.
Thank you, Eric. Okay, so before I do any spoilers, we have a bit of context that we want to give around what's happening with the valuation and the market that we're in at the moment. So if you move to page number 45 in your packs, we first of all give some background about what we, Eric alluded to, that 1.5% that we included in the last valuation for contribution rates. Now, when the 2019 valuation was going on, there was quite a lot of uncertainty around the McLeod remedy. So just to recap, the McLeod judgment was when the public service pension schemes changed back in 2014, 2015 to be career average schemes across the board, not just the LGPS. There were certain members who were within 10 years of their retirement age at that time, which were given protections so that they weren't adversely affected by the change in the structure of the scheme. It's been determined through some challenges, and not through the LGPS, but through other public service pension schemes, that was unfair age discrimination. And that was upheld, and therefore all the public service schemes had to have a remedy to ensure that this unfairness was taken out of the scheme. And that comes, obviously, if you're taking away that unfairness, you're maybe giving members some more generous benefits, that comes at a cost. So in the 2019 valuation, we weren't sure what the remedy was going to be and how much it would cost, but we had to estimate it. At the same time, there was the cost management going on. So this is an assessment that the Government Actuaries Department carries out every time there's been a valuation. Every 4 years they do, actually. And they are looking at whether the costs of the scheme are getting more expensive or less expensive than they really expected over time, and which may mean that the benefits need to be changed to be more or less generous to members. So it's things that are outside the members' control. Should they be having to pay for those, essentially? And actually, at the time of doing the last valuation calculations, that cost management process had identified that the benefits were actually not generous enough. The cost of the scheme had gone down compared to the expectations. So this is a really difficult message, because actually employers were seeing increasing costs at the same time as being told the benefits weren't generous enough. So it's a real challenge, a real conundrum. But the reason we've added that 1.5% into pay last valuation is a combination of these two factors. So to allow for the fact that employers may have had to increase benefits, and the fact that there was this McLeod stuff going on. So for this valuation, we just wanted to update you on what we're doing about that. We now know we're pretty sure what the McLeod remedy is, and we've been able to, we don't have the membership data available to do it really accurately at the moment, but we've been able to be much more accurate within our calculations and employ, a past service calculation to apply to each employer's position. So that it is a lot more accurate, and it is all in the past service, as Eric mentioned. The McLeod remedy sort of went up until 2022, so it is all past service. There's no more future cost for that. The cost management process, in the last 3 years, it has been decided that McLeod costs can be included in the calculation of that cost management piece. And McLeod increases members' benefits, and as a result of that, it did mean that the cost cap or the cost floor was no longer breached. Therefore, we didn't need to make that extra allowance for that. So both of those things have gone away from this valuation. We're not making allowance for them. However, and we move on to page 46, we still are quite cautious about this because, and the slide just gives a bit of a timeline about what happened with cost management, which I've kind of just alluded to. But the inclusion of the McLeod benefits, or the McLeod rectification in that cost management calculation, has been challenged by trade unions because essentially they sort of see it's not fair to members to make an allowance for something that should have been theirs in the first place. So there is that challenge going on, and it is still, we won't get a decision from those judicial reviews before the end of this valuation. So while we're not including it as a loading in the employer contributions, we do want to be cautious about when we're thinking about potentially reducing any individual employer contributions, just because Eric said we try to keep things stable over time, and we don't want to reduce contributions and then find at the next valuation we have to increase them. So that's a bit of context about that particular part. Moving on to slide or page number 47 in your packs, just looking at things that have happened since the valuation date. Because this is kind of unprecedented times. Things have been very volatile. And while the fund has actually done quite well in protecting itself against some of the potential asset shocks it may have faced, the investment returns have gone down since the valuation date, and we're quite aware of that. Now you have in your funding strategy a sort of surplus buffer. So you won't recover, you won't sort of give back surplus to employers unless they are over 110% funded. So rather than giving it back so they get back to 100% funded, you sort of target the 110% level. And that's useful in an environment like this when we know that the assets have fallen since the valuation date. So actually, if we were to do the valuation today, the funding position may be different. On the other hand, we're having a look at what that's done to our expected returns, and therefore your discount rate that we would use if we were doing the valuation today. And that actually would have gone, that would have moved into more positive direction. So we would expect, once the assets have gone down, your expected returns to go up. And overall, for most employers where we set your funding strategy in the way that Eric described, we wouldn't actually potentially see that big an impact from the post-valuation experience. So we're not proposing to do anything about that other than take this cautious approach that we've talked about around that increased level of probability of funding success. The exception to that is there is an employer who's subject to lower risk assumptions, but we're dealing with that employer separately and potentially setting contributions having regard to the fact that things have changed in the market because they're using lower risk assumptions, which actually have improved since the valuation date and become more favourable for that employer. So we are taking that into account. So if let me just, I think I've got a question.
Thank you, Chair. Thank you, Laura. Just thought I would interject very briefly as the representative of Hyman's Robertson, the investment advisor to the fund, just to echo some of the comments that Jeff made around the steps that we're taking, and we're working to reduce the level of investment risk, which go in tandem with some of these valuation assumptions. In fact, some steps have been taken already, some divestment from the equity and an allocation to trade finance, which is a low risk asset class. So I'll touch upon that in more detail in our investment section, but I thought I would mention that we're very cognizant of the strong investment returns and that markets are now more volatile. So we need to take some steps to account for that. Thank you.
Yeah, thank you. That's great. So when we're doing this valuation process, it's really important that we talk to the investment advisors and what's going on with the investment strategy because they're very closely linked. So yeah, thank you for that. So as I said at the beginning of the presentation, what's really important is we as the actuaries are the ones who actually determine what the employer contributions will be, but we have to have regard to the funding strategy, which is the administering authority document. And we support you with drafting the funding strategy, but it is essentially your strategy. So we aren't proposing to make significant changes to the strategy other than what we've talked about with the increased probability of funding success. So increasing the level of prudence, reducing the amount of risk in the funding strategy. So we just on the next couple of slides, we've just talked about some of the things that we are proposing that we retain in the funding strategy. On page 48, this is the piece about only recovering surplus where it's above 110%. So we're proposing to keep that wording pretty much similar, or the same it is at the moment. Page 49, we've got in here about how we pool risks for smaller councils, and Eric sort of alluded to that already. So we're not making a material change to that strategy either. So basically, it's just to help those employers with stable contributions. And on page 50, we then have a sort of summary of the outlook for contributions for those long-term stable employers. So as we've talked about, the fund has done really, really well. We do want to give employers some credit for that over the period of time. But we do have, we are cautious about what's happened since the valuation date and particularly in relation to inflation. So we don't want to go too far and then increase contributions at the next valuation. So the funding level has improved considerably. Lots of employers are now over 100% funded, so there will be no need for them to pay deficit contributions. But we are going to be cautious about reducing contributions below the future service cost. We will spread surplus over a long period of time so that it doesn't result in really quick, short reductions for most employers. And there are a few exceptions to that. We'll use that surplus buffer of 110%. Future service costs have increased, but we have taken out that 1.5%, which will help with that as well. And then in terms of strategy, then we've got this additional short-term inflation allowance, which has increased the liabilities. But we are looking to avoid material contribution reductions, as we've said. And one of the key things to mention, which came out after we did these slides, but there has been a sort of letter that's been published by the Scheme Advisory Board, which has said that it acknowledges that lots of LGPS funds have seen improvements in funding positions, but they are warning against reductions in, significant reductions in contributions just because of the current market that we're in. And I think on every measure that they've mentioned in their letter, you have either retained the level of prudence or you've increased it. So I think you're in a good place in regards to what the Scheme Actuary Board would be expecting from the fund. And finally then, on page 52, just to summarise what we do next, we sort of subject to your agreement with, the strategic elements in terms of the level of prudence. We can say that the fund has done well. We can determine the employer rates and get those communicated to employers and finalised. We will sort of help the administering authority develop the funding strategy statement. As I said, we don't think there's going to be significant changes to that, assuming that everything that we've said today is okay. And then we will produce a final valuation report by 31st of March next year, 2023. And that will include a schedule of all employers' contributions for the following 3 years. We set contributions to last for longer than that, but we only report them for the next 3 years, the next time we do the valuation. So that's it from me and Eric, and we're happy to take any more questions you may have. Thank you, Chair.
Thank you very much, Laura and Eric. Can I ask members if they have any questions or comments on this report? Bill?
Well, I got no comments, Chair, but obviously with a smile on our faces when you say, especially that the employers no longer need to pay any deficit contribution. I think we've got to realise the benefit to the council as a whole, especially with the way things are going at the moment and what we'd expect in, providing we stay 100% funded, then the council are also benefiting from this. So long may it continue, as we say, like from a councillor's point of view. But yes, we have moved on tremendously.
Thank you, Phil. Anyone else?
Jeff.
Oh, Jeff. Okay, pass you. Jeff.
Thanks, Chairman. First of all, I'd like to thank Laura and Eric for the work they've done on the valuation. They've worked in a very timely manner, and I think we were one of the first admin authorities to receive preliminary results this year. That's a testament to their professionalism and timeliness of the work and the team that they've got back at Aon. But also like to give credit to our admin team led by Claire Elliott, who were responsible for collating that data and submitting it to Laura and Eric to do their hard sums. Without that good, clean data, and I think it's been recognised in the slides, the guys couldn't do their work in such an efficient way. So thanks very much to Laura and Eric for that. Just to come back on Councillor Downing's comment, we did have the annual consultative meeting yesterday, where all employers were invited to receive their preliminary results from the 2022 valuation, and suffice to say, those employers were pleased with the outcome in terms of the impact on their budgetary positions going forward. In reference to your point, Councillor Downing, on our two largest employers, Swansea Council and Neath Talbot Council, our actuary colleagues have had personal meetings with both the directors of finance of Swansea Council and Neath Talbot Council, and shared the good news with them, and your assumptions, Councillor Downing, about being of great benefit to budgetary considerations, not only for next year but for the next 3 years following that. I've been very welcome at this challenging time. Obviously, the whole public sector awaits what the government has to say on the 17th. But no doubt the outcome of the work of the guys over here will have a material positive impact on the budgetary positions of both Swansea Council and Neath Talbot Council. I don't want to share quantitatives at the moment because obviously it's all subject to Laura and Eric finally signing that certificate off in March. However, the indicative outcomes of those contribution rates have been duly shared with the finance directors of both Swansea Council and Neath Talbot Council.
Thank you, Jeff. I see Nick Jellimer from our investment consultants is wanted to come in. Nick?
Thank you, Chair. Just a brief couple of comments sort of as an investment advisor on the discount rate assumptions and the inflation sort of assumptions. So on the discount rate of 4.1%, just to say that I think even though maybe in the medium term there's a lot of uncertainty around economic conditions and investment market conditions, I'm personally very confident that we can still be delivering considerably above a 4.1% return on the investment strategy, and that's even with some of the steps we're taking right now to sort of reduce the amount of risk in the investment strategy. So that's certainly very positive, and I have a good outlook on that. On the inflation assumption, I just wanted to flag in a way that there are some sensitivities and uncertainties in Aon's report, and clearly there is a risk around inflation, particularly to the funds. You know, Aon have spoken about the rate, the CPI assumption being 2.3% in the long run, and yes, there's this inflation loading sort of around that. But there is undoubtedly a lot of inflationary pressure around the world at the minute. I guess in the round, although the inflation, the inflation assumptions are trying to take account for that to inflation loading, reducing increasing the prudence in other assumptions is also trying to sort of account for that. So I think in a package, it's a very prudent set of assumptions, but clearly if inflation runs considerably above 2.3% for the medium term, for the long term, then that will clearly have a material sort of negative impact. But at the minute, we're sort of coming from a position of strength, which is good. Okay, that's all I wanted to sort of comment on, Chair.
Thank you, Nick. Excellent. So, if there's no more questions, I will now call for a vote on the assumptions included in this report. Can you take the vote, please?
Okay, Councillor Patience-Bentu. Councillor Patience-Bentu. No. Councillor Phil Downing.
Yeah, for it, Chair.
Councillor Michael Locke.
For.
Councillor Will Thomas.
For.
And Chair.
For.
Thank you.
Sorry, Chair.
Yes. Do you want to cast your vote, Patience?
Yes, for, Chair. Apologies, my Wi-Fi is a bit iffy this morning.
Thank you very much. Thanks for coming back in.
Thank you, Chair, and thank you, everybody. It's been a pleasure. Cheers.
Moving on to the next item on the agenda, which is item 6, and this is the report of the Section 151 officer. The first is 6A, the annual report and statements of account for 21-22. Carry on, Jeff.
Thank you, Chairman. This obviously relates to the earlier report of Audit Wales and our appointed auditor, Gillian Gillette, where she presented her audit report on her findings after having audited the annual report and statement of accounts 21-22. The committee would have already received the draft set of these accounts earlier in the year, and at that point in time, I would have taken the committee through the annual report and statement of accounts in some detail at that time. What I'm not proposing to do today, Chairman, is go through all 250 pages line by line. You'll be disappointed to know, Councillor Downing. I was just going to pull out some highlights from the report, just some salient highlights and key metrics, which I think you'll find of interest contained within the annual report. As you're aware, Swansea Council is the admin authority for the City and County of Swansea Pension Fund, and that represents about 26 active employers. Some of whom came along to the annual consultative meeting yesterday. As I say, they include Swansea Council, Neath Talbot Council, but it also includes educational establishments like Garrett College, University of Wales, Trinity St David's, and some housing associations like Neath Talbot Group, Titarian, Pobble. So a variety of public sector and quasi-public sector employers. In the annual report, we're required to report on some key metrics in terms of the membership of the fund, and membership of the fund has increased slightly during the year up to just under 48,000 members, comprising of 21,400 active members. These are members still working and contributing to their pensions. We've got just over 14,200 pensioners, and these are people actually drawing down on their pension and enjoying their pensions that they've accrued during their working lives. And then we've also got 12,263 deferred members. These are members who have accrued benefits within our scheme, but are not yet eligible to draw down on that pension. So they'll draw down on their pension when they become of normal retirement age or take a retirement elsewhere in the LGPS. And as I'm want to say in these presentations, despite public perception, despite popular press reports, the average pension in payment in the LGPS and in Swansea in particular is just over £5,000 per annum. It's not a huge amount, and that's gross. It's not the gold-plated pensions that are often referred to in the popular press. And as earlier reported by our actuary, LGPS benefits are linked to inflation, and in the LGPS it's linked to the September inflation figure payable in the succeeding April. So in April 2023, the pensions uplift will be 10.1%, and that is why the actuary, as he indicated in his presentation, and Laura, she indicated in her presentation as well, why they're recognising that short-term inflationary pressure in their assumptions going forward. Also in the annual report, obviously, where we talk about the financials and the net asset values of the fund, and as you can see, the fund value now sits at just shy of 3 billion. Didn't quite get over the 3 billion mark, but we sit at £2.924 billion, and in year that's an increase in fund value of just over £310 million. So that fund return during that financial year of 10.7% ranks the fund about 12th in the local government universe, and that local government universe comprises of about 89 other LGPS funds. And in terms of size, you know, at £2.924 billion, we're one of the smaller, larger funds, if you see what I mean. We're definitely, you know, middling in size there. So the fact that we've ranked 12th definitely indicates that we're punching well above our weight in terms of investment performance relative to size in that regard. And even more pleasing, I think, is the metric over the 3 years ending 31st of March 2022. Not only was it important because it's the valuation year and valuation date, so the crystallization at that point in time is very important. It also was bookended by that 3-year period was bookended by you know, the COVID crisis and also the Russian invasion of Ukraine, and despite those two major events, the fund returned 11% during that 3-year period, ranking it second in the whole universe during that 3-year period, which sort of reflects the very positive outcome that we had at valuation, because that 3-year performance was taken into account in the actuarial calculations that our colleagues undertook on our behalf. And even over the longer term, over the 5-year time horizon, we returned 8.3%, ranking the fund 8th out of that 89 fund universe. So in terms of short-term, medium-term, and longer-term investment performance, very healthy, very positive. But as I say, the outlook going forward perhaps may not be quite so outsized relative to our peers because of this de-risking strategy that we're undertaking now, and the expectation for us to have those outsized returns going forward will be slightly diminished because we are taking slightly less risk going forward. You know, investing in yielding assets, investing in diversifying assets that Andre and Nick have referred to in their questions so far. Again, I just wanted to touch on the funding level. Again, very pleasing that the actuary has been able to report that 31st of March 2022, he's going to sign off 100% funding level, and that's at the increased prudence levels of the 2022 valuation. If undertaken at the 2019 valuation assumptions, we'd have been at 110% funding level. And as I say, don't want to labour a point, but it is for the first time at valuation date that we are actually in surplus at that point in time. So that's very positive. Again, the annual report indicates some challenges that are facing the fund in terms of the implementation of the McLeod remedy referenced by Laura earlier on in her presentation, the ongoing GMP reconciliation and work that we're doing with HMRC in terms of reconciling members' benefits in respect of minimum pension that a member is due. There's ongoing system upgrade and migration to iConnect, ensuring more efficient dialogue with our employers. Obviously, you know, that the triennial evaluation has been ongoing, and you know, we've received the outcome, the initial outcome of that hard work during the year. And then looking forward, you know, the team are busy preparing for the implementation of a pensions dashboard. This is across the whole pension landscape. But those of you who have, you know, personal private pensions will no doubt be aware that your pension providers are obliged to provide you with a pension dashboard in due course. We're no different. Our staging date for compliance with that requirement is September 2024. So we're busy working with our IT providers in preparation for dashboard preparation. Also, we'll hear later on today's agenda how we're progressing in terms of our net zero journey and our aspirations to achieve net zero by 2037, but also from a compliance and governance and reporting perspective, we have obligations to report in respect of our TCFD requirements, and that's the Task Force for Climate-Related Financial Disclosures. Again, the Scheme Advisory Board is working up their guidance on what that will look like for the LGPS, but that is due to be implemented in the next 12 to 18 months. And in recognising all that good work and all those excellent achievements, I think it was announced at last council at the last Swansea Council meeting. I'm pleased to share with committee formally that the pension fund has been shortlisted for 3 local authority pension fund awards for 2022, and that is for Pension Fund of the Year, greater than £2.5 billion. The best climate change strategy of the year, and best investment strategy of the year. I think the results will be announced on December the 15th. So fingers crossed as far as that's concerned. And lots of the other items which I did have in this presentation are sort of covered in my Wales Pension Partnership update, which is already a formal item on the agenda, Chairman. So with your indulgence, I'll skip those and save those for that part of the agenda. Happy to take any further questions that you may have on the annual report, but the report, the audited and amended statement of accounts is before you for formal approval, Chairman. Thank you.
Thank you for that, Jeff. Have we got any questions from members on this report?
I Chair, just only to put on record, thanks to the team, and great job that Jeff and his team have done. And it's fantastic. There were 100% valuation, which is down to their hard work, and so just wanted to say thank you for that, and well done to Jeff and his team. Thanks.
Thank you, Will. Bill.
Yeah, and it's nice to see that when we went out to the public, we had 98% compliments. I think this is alien to us councillors, getting compliments. But yes, it's nice to see that we're getting support from the rank and file, as it were. You haven't put down how many people replied, so but no one a pension. It's a very good response.
I think that may be a function of being a pensioner, Councillor Downing. I think anyone who's in receipt of a pension or about to receive a pension is going to be of a happy disposition for the fact that they don't have to work anymore, isn't it? So hopefully that keeps down the complaints.
And the other thing is, it's good to hear that we've been shortlisted as well, and I hope that the right people are listening to the ones, especially on the climate change one, and give us compliments. Which would be alien to other people.
Thank you both. And just to say on behalf of this committee, and just to reaffirm Jeff's earlier comments, thanking Karen Cobb for preparing the annual report and statements of account. So thank you very, very much, Karen.
Thank you, Chair.
We're going to vote. Yeah. Yes. We need to vote on that report. So can I pass you over to Jeremy?
Okay, recommendation is for approval. Councillor Patience Bentu.
For.
Councillor Phil Downing.
For.
Councillor Michael Locke.
For.
Councillor Will Thomas.
7. For.
And Councillor and Chair.
4.
Thank you. That's approved.
We now come to part of the agenda where we have to exclude the public. So can I call for? Oh, sorry. Have I missed something? Oh, sorry. I do apologise. Turned over too quickly. Right. Yes. Again, we've got 6B now. We've had 6A. So again, a report of the 151 officer. So over to you, Jeff, for this.
Thank you, Chairman. I'll keep it brief. It's the usual breaches report where we're required to report to those charged with governance the technical breaches within the scheme, i.e., late receipt of contributions, late submission, and processing of some member benefits, etc. The new breaches since last time they reported are outlined on page 330. Sorry, on page 329, 329 onwards, and on page 330 and 331. Those are the new breaches. The usual suspects and usual reported items on there. Small numbers, small amounts. Happy to take any detailed questions, Chairman, on the same.
Have we any questions? No, thank you. Right, moving on into 6C, which is the Wales Pension Partnership Annual Update 21 to 22. This is you, Jeff, again. Thank you.
Thank you, Chairman. In line with best practice, the Wales Pension Partnership produce a quasi-annual report as well. And this is the summarised version of the same that constituent authorities are sharing with their committees. It's quite a high-level report in terms of the work plan, and as you're aware, Chairman, and the rest of the committee, you receive quarterly updates anyway of the work of the Wales Pension Partnership as part of this reporting pack, and indeed later on in the agenda you will have a detailed report on some of the more sensitive items. However, this report quite importantly highlights some of the engagement work that the Wales Pension Partnership is undertaking in respect of its constituent authorities. As you know, it engages Rubico as their engagement and stewardship provider, and on behalf of the Wales Pension Partnership, they engage with investee companies and lobby and encourage best practice and good corporate behaviours. And as you can see there at the bottom of page 33, you can see some of the activity that they've undertaken on our behalf, and the volume of that activity in that table at the bottom of page 333. Increasingly, you'll hear later on from Andre and Hymans that engagement is the third weapon in our or tool that we have at our disposal in implementing our climate change and net zero strategy, but also runs as an important tool in the rest of our ESG strategy. And as you can see here, it at work. Yes, members can challenge the efficacy of it, and here it's quite dry in terms of the numbers and of votes for and against management. But at its training sessions and further meetings that committee members are invited to, there is a deeper dive into the issues underlying these numbers, such as working conditions and health and safety at investee companies. So members do have the opportunity to dive deeper into these issues, should they be of interest when Rubico do hold their periodic update sessions via WPP, which all committee members are invited to in actual fact. Happy to take any further questions. It is quite a brief report, Chairman. Thanks.
Doesn't look like there's any questions. That was for information only. Moving on to 6D, which is the pension administration resources. That's on page 334.
Thank you, Chairman. There is a formal recommendation attached to this report, and I think Laura and Eric didn't make reference to this earlier on, but they were quite instrumental in and Aon were in helping us discharge a whole program of trustee training earlier in the year, recognizing the fact that we've got a whole new raft of members both on the pension fund committee and local pension board. One of those detailed areas of training was around pension administration, and we had a very productive session going through responsibilities of an admin authority in calculating benefits, how they're calculated, etc., etc. Because when all said and done, that is the main objective of the pension fund, to pay members benefits. And what came out of that session and workshop was the importance of having adequate resource for that team and function, and what this report is asking for approval for is a recommendation to bring that resourcing in Swansea in line with our peers in the rest of the WPP and the rest of Wales. We're not asking for over above resourcing more than our peers. We're just asking that resourcing is brought up to and in line with our peers in the rest of the LGPS in Wales. Largely, we could be accused of being late to the party, of not addressing this issue sooner, but one of the benefits of the post-COVID working life is the flexibility that it affords in this hybrid working arrangement, and historically the size of the team has been limited by the office accommodation available to it, and so we have maxed out the office accommodation previously, and so physically we could not increase the team anymore because there wasn't enough office space to do so. However, now with remote working and hybrid working, we can offer that flexibility, and we can engage and employ those additional members that the work and the challenges which are outlined within the report, that again I'm not proposing to go through in detail, but you can see the challenges facing the admin team, such as the ultimate McLeod remedy, member aggregation, the ongoing GMP work, and then also with the introduction of the National Pensions Dashboard that I referred to. So there is a lot of work on there currently and on the horizon, which justifies this additional ask. The asks are identified in detail on 5.4 to 5.7, and the financial implications associated with those recommendations are identified at 9.1 and also 6.3. And just to give you some idea of what that means in terms of percentage of fund value. I mean, the cost of administering, the cost of the admin team in totality represents 0.00002% of fund value. So in terms of one of the most important functions of the pension fund, in terms of how much it costs to discharge it, it's 3 zeros and a 2, basically, that in relation to the size of the fund. So happy to take questions, Chairman.
Any questions from the floor?
So what are you actually looking for, Jeff? So we got 20.5 now, full-time employee. I'm looking for an extra 4.
We're looking for an extra 4, Councillor Downing.
I did read it right then.
We, as you can see, in comparison to our peers, we are at 20.5. We're below our most direct comparison, which is the Cardiff and Vale Fund, which is the one most broadly similar in terms of membership numbers. They have 24 currently, and looking to fill 7 vacancies. So even with our additional 4 that we're looking to fill, that only brings us up in line with them currently before they filled their vacancies.
So the other question, this 4, are they with us temporary now, or are they new posts that we'll be advertising?
There'll be new posts, Councillor Downing. Yeah. So the 4 temporary that we've got, we will make permanent to bring it up to 20.5, and then we'll ask for an additional 4 on top of that to augment the admin team. Yeah. Sorry. And then also there's an additional ask in terms of one additional accountancy assistant to augment Karen's investment management. That's outlined in 6.3 of the report. And again, that's included in that 0.00022% of the value of the fund. Obviously, with the increase in private market assets and the increase in financial due diligence and legals required to provide oversight and manage the capital calls and distributions in respect of those disparate investments. Basically, Karen is close to breaking point in that respect, and it's only appropriate that additional workload is recognised with some assistance in that regard.
Thank you, Jeff. And just to say that as chair, I'm a huge advocate of this report, and I hope it moves towards evening out all the administration problems we've had over the last 6 months. Thank you. Right, I believe this has to be voted on. So if I could go over to Jeremy to call for the vote. Thank you.
Okay, recommendations is to approve the resourcing and budgetary additions identified in 5.4, 5.5 and 6.3 of the report. Councillor Patience Bento.
For.
Councillor Phil Downing.
For.
Councillor Michael Locke.
For.
Councillor Will Thomas.
For.
And Chair.
Yes, for.
That's approved. All in favour. Thank you.
Okay, right again. Now moving on to exclusion of the public. Can I call for a move? Pose on seconder. Thank you. Thank you. Do you have to vote on this? No. Okay, there we are.
Chair, recording will stop.